Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Beko and my partner, Hari.
Hello.
Hope you guys are doing well. We are recording this episode towards the end of May. I hope you guys are doing well. A lot of things are kind of coming above the surface with the coronavirus kind of tapering down and economies opening up. I hope you guys are doing well in your health and your professions and family and otherwise. So let's get started with this episode. In this episode, we're going to be covering this company called Cummins. Hari, could you give us a disclaimer before we start?
Yeah, this is the Value Investor TV podcast. We are a podcast that helps you understand the concepts behind value investing. We are not financial advisors. We don't know your specific financial situation. So if you are making financial decisions, please consult with the appropriate advisor before doing so.
Great. I hope you guys can notice that we have put some effort into improving our audio. So Hari, he has a new microphone, and I have a new setup so that we don't have a lot of background noise with microphones. So hopefully this will help you guys. It might be. Hopefully, it's easier on your ears.
Yeah, and you'll also notice that Beko has put in some time on shaving his face. So he has cleared up the coronavirus growth and is back to normal.
Exactly, back to normal. Today is, Memorial Day here in the U.S., and it marks the first day of the summer. I thought it's appropriate time to go back to normal, and hopefully, along with the economy and everything else, we'll be back to normal. So,
and if you'd like to see Beko's nice smooth face, you can check him out on YouTube. If you're just listening.
Please do, or listen, or either way. Anyway, all right. So this company, Cummins, as always, we are going through a checklist. When we analyze companies, we go through a checklist. And if you guys want access to our checklist, please email us at info@valueinvestor.org. And if you would like access to our Slack channel, and that's where we discuss with our community, with our listeners, you guys, various topics on economy, on specifically, specific questions on specific companies, anything in between. And if you guys would like access to our Slack channel, please email us at info@valueinvestor.org as well. Okay, great. So Hari, should we get started with this company?
Yeah. So as Beko mentioned, we go down our checklist, and on that checklist, we use that to systematically go through companies, because if we don't, we are liable to get off track or miss something. So we want to use that checklist and adhere to it as much as possible. So that the first question on the list is, what does the company do? You should be able to answer this question in less than 2 sentences.
Okay. I'm going to try my best. This is my weak spot because there's so much content that I want to deliver. But effectively, this company makes diesel engines and power generators. Was that clear enough?
Okay.
So this company is based out of Indiana, Columbus, Indiana. So a little bit more color on that. Indiana, and they were founded quite a long time ago, almost 100 years ago, actually more than 100 years ago, in 1991. I think this is important. I want to emphasize this part. They design, manufacture, distribute, and service. So all components of the entire value chain, they do all of it. Design, manufacture, distribute, and service. Diesel engine, natural gas engine, electric and hybrid powertrains. They do fuel system, turbochargers, control systems, air handling systems, automated transmissions, electrified power system, hydrogen generation, fuel cell products. These are the things that they produce, manufacture, and distribute. So you can kind of see that they're kind of doing several things related to vehicle, related to power and things like that. But the main line of business is really diesel engine and power generation. So generators, effectively. I can provide a little bit more color on their footprint. So, for example, they operate out of 190 countries. So they're based out of US, but they operate all over the world. Um, and we can go into this a little bit more later, but they have five different operating segments. And as usually, any companies, they'll divide their divisions and segments into business lines, and this company is not an exception, of course. And so they have five different operating segments. The first is, as I mentioned, engine. That's their primary business. They make diesel engines and otherwise related to engine. That's number one. Number two is distribution. So they have distribution sites where they will, it's basically a retail outlet. It's a brick and mortar outlet where they will distribute their products. That's the second operating segment. The third operating segment is components. So anything that goes into the car or making a vehicle, they also make little component parts. So that's the third operating segment. The fourth is power system. Power system is, as I mentioned, these are generators business. And then the last one is new power. In terms of material impact to the entire corporation, new power is really tiny, but it's an up and coming segment that is really focused on new green, more eco-friendly kind of power. So you're talking about hybrid, you're talking about electric, things of that sort. So five different operating segments.
Okay. I think we'll get more into the business as we look at some of the next questions on the list, because that'll help us kind of answer. As we answer those, you'll have to fill in some of the details to help us. So let's actually start talking about the business and its competitive advantage. So, one, do they have a competitive advantage? And if so, let's describe them based on these categories. Do you think the brand has a particular advantage? And what do we mean by that? We mean that if based on the brand name, their service or good will be picked over another competitor.
Yeah, I think this question is an interesting one in when you are talking about consumer business, right? Consumer business are a lot more swayed by the impact of a brand. Like, for example, you can think about Nike or Apple, for example. They have a really strong brand, and that is in of itself a very strong competitive advantage. When you're talking about more of a B2B business, I think that brand gets a little bit diluted, in my opinion. And I think this is also the case. For example, their customers are not us consumers. Their customers are, car manufacturers, truck manufacturers. So, for example, really a big one is like Daimler or Caterpillar or Volvo or Ford Motor Company. Uh, you know, companies in that category. And I would say from that perspective, they do stand out as kind of premium class diesel engine. They go back 100 years. They've been making diesel engines for a long time. They're really well known in the space. So I would say the impact of brand actually does contribute to their competitive advantage. But I wouldn't say that this is the thing that they stand on to compete against other companies.
Okay. Um, let's look at the next question, which is network effects. So a network effect is with a business because they have you know the presence of that business allows people to come to it, and so that the idea here is, for example, eBay. The people go to look at eBay because there are sellers on eBay, and sellers go to eBay because there are buyers on eBay. So, are there any network effects that we see with the Cummins, line of products?
Yeah, I don't think so. As you mentioned, I think network effect is most predominantly exhibited by social media companies or any kind of marketplace companies, right? Where you have both the seller and buyer, and they are in the middle, allowing the transaction to happen. Like, I think a good example here, like you said, is eBay. Another one is Facebook. I think they kind of popularized this moat, this competitive advantage of network effect. There is also like Visa, for example. They have a strong network effect. We talked about that in our previous podcast. And so network effect is really predominantly exhibited by companies that are playing in the platform space, the marketplace space. Cummins is not a platform player. They produce diesel engines. When you buy a diesel engine, it doesn't make it more. When many more people buy it, it doesn't make it exponentially more valuable. So I would say no here with network effect.
Okay. I mean, so one other way that you could have a network effect is that because the Cummins brand is so popular, um, you know the you know OEM shops are more likely to carry their products, so are more likely to end up buying it. I mean, it's not a strong network effect, but do you think that there is a potential there that because of their size, their history, their scope, um, another way to think about it is, in order for you, if you're going to buy a product and you're going to need to get it serviced, which engines need servicing, you need a network of people who can actually do the servicing. So that if without that network, it would be difficult to to have this product, right? So the way I'm thinking about it is, and again, I'm not saying that this is a strong moat, but for those of since this is somewhat of an educational discussion too, right? If Becco and I were to start a diesel engine manufacturing business, right, we would need to have somebody to actually service those. We're based in Texas, for example, somebody in California can't get their engine serviced. Well, then they may not buy their product, right? Especially if this is for a major if you're in a commercial business that you need these things serviced all the time. So in my mind, there is some network effect there because there are people who are able to service the Cummins product line and so on. And that is a barrier to entry, although not necessarily the strongest one. I mean, do you agree? Do you agree with that statement, or do you think, based on your reading, that that's not the case?
Yeah, I think so. As I mentioned earlier on in the top of the episode, I talked about distribution as one of their operating segments, right? And they actually the distribution, the brick and mortar business of Cummins, they bring in about 8 billion a year. So I mean, this is a sizable business that's all across the world, all across this country and other places that allows people to service their engines and their generators and whatever they produce, right? So from that standpoint, they do have a expansive network of service providers, right? The aftermarket service providers. But I'm not quite sure how to think about that and think about our classic definition of network effect with Facebook, for example, right? I think when we think about network effect, we really think about it from the perspective of as more people buy it, not from the company side, as the more consumers get into it, the value of what they're purchasing goes up. Whereas I think with this, it's more of the company is providing all these different service layer across their product that makes it more convenient for users to purchase these products. So I think we're talking about a slight nuance difference where the former one, the one that we kind of think about network effect in the light of social media companies and these kind of marketplace companies is one where as users you go in and you buy more of it, therefore the value of the product goes up. I think in this case it's the company that allows quote unquote network effect to exist.
Mm-hmm.
Yeah.
Okay. Well, I think for this company, this one may be more interesting to discuss. Do you think that they have a moat that is or competitive advantage based on switching cost?
Yeah. So I think this one is a yes. I think with any kind of component producing companies that are upstream in the value chain, and we talked about obviously Cummins is one of those companies. You talked about Allison Transmission. We talked about before recording this episode. They produce parts before it becomes part of the final product that consumers produce. Another one is say like NVIDIA. They produce parts that becomes computers. What else? there was one company. Oh, there's the airplane part manufacturer we talked about. Do you remember, Ari?
I know what you're talking about. I've forgotten the
Yeah,
name now off the top of my
yeah,
head.
exactly. So I think anyway, those types of companies that produce parts upstream from the end product itself, if they can kind of wedge themselves in to the value chain and become sole provider or one of the fewest providers that actually make the thing and allow the manufacturer OEM vendors to produce the final product with with your product, it becomes really difficult for them to rip out your product with something else. And
Well,
I would say this. Yeah, go ahead. Ari,
no,
you
no.
can say
I
something.
was just gonna say that the main distinction there is that there are a lot of businesses that are supplying OEMs and so forth, but the value proposition is, and the distinction that has to be made is that the actual product that they're supplying is not a commodity, right? In the case of Nvidia, it's a highly differentiated GPU that you can only buy Nvidia chips. You can buy it from many different manufacturers, but from end manufacturers. But Nvidia is the only place that you can get the specific artificial intelligence, machine learning, etc. stuff. So, um, you know, in that light, is Cummins providing a commodity service, or are they providing a commodity product, or are they providing a product that is well differentiated that it would not be easy to just swap it out, right?
Yeah. Before I answer that question, the company that we were just talking about, it came to my mind, TransDigm.
Yeah.
Right. Yeah, TransDigm. I think they are a good example of the switching costs where they are really the only manufacturer for 80% of the parts that goes into an airplane. I mean, that's a big switching cost. Anyway, going back to our discussion here with Cummins. Um, so the question of whether the thing that they produce is a commodity or not, I think from the standpoint of it being diesel engine, right, there's only really a few players that are making diesel engines, and I think they I think one of the key characteristics of a commoditized product is that the performance delta from one product to another really doesn't matter. So the performance is way above what users really demand. Therefore, other things matter. For example, convenience, for example, reliability, for example, price. Whereas in this one, I think it is not quite a commodity because there's still the delta of performance between Cummins and some other diesel engine actually do matter because we're talking about more efficient diesel engine, we're talking about higher horsepower engine. So I wouldn't say what they produce is totally commoditized, but there is an element of commoditization here. I think this industry is kind of heading towards that direction, in my opinion, because as these companies produce better and more fuel efficient engines, the delta between performance really is overshooting what customers demand in the market. And so I think we're going to see that in the future. But I would say right now, um, it's not really a commodity, um, with that nuance.
Okay. So let's keep moving here. Looking at the next category, do you think that they have the ability to provide their goods and services below below cost of their competitors? So do they have a low cost moat?
So I don't think so. Um, I think yeah, they're not really low cost provider. I think a good example of low cost provider we talked about is Skechers. One of the companies that we talked about earlier on in our podcast journey. Skechers is a low cost provider. Cummins really not really is really doesn't really belong in this category in my opinion.
Okay, and then the last one on our checklist is, um, does this company have any intangible assets that you would consider for a competitive advantage?
Yeah, I think when you talk about intangible assets, we always think about like patents and things like that. And Cummins explicitly said, they in their 10K that they have a lot of patents, but here's exactly what they say. They say the company doesn't believe that it is material to the business. So, they have a lot of patents, but they don't really think that it's material to the business. Another thing that we talked about before recording this podcast, Hari, is the fact that they are in capital intensive business, right? We
Yep.
talked about several businesses that are in this category where just by the mere fact that they're in capital intensive business is a deterrent in and of itself from entrants coming into this market.
Yeah, I mean, I think if you're trying to start a new business in that area, it's becoming harder and harder to get capital for capital intensive businesses, right? When a venture group is going to be investing, they're going to put money into startups that are capital light. So, the financing for a business like this is, if you were to start it today, would have to come from, from more traditional sources of funding, which may or may not be as interested in investing in something like this. And there's certainly, I mean, how do you compete with a business that has 100 years of history, right? It's very difficult to do that, right? When they have a fairly significant lead, you have to build up the patent portfolio, even though it's not necessarily, you still have to get the expertise and things like that to build it. So, there is an intangible asset there. It's just not something that we can measure. The 100-year history is, domain knowledge and, company knowledge that, we would put in there. But again, that's not necessary. I mean, think about this, if you were amortizing these intangible assets, for example, their knowledge from 30 years ago of building diesel engines that they still use today on parts costs them zero, right? After it's been amortized away, right? But they still are utilizing that knowledge base. So money that they spent in the 70s or the 80s or the 90s is still valuable to them today because of the type of business that they're in. So you have to compete with that, which is fairly difficult to do, right? So, I think we're going to see here that they probably do have a fairly significant moat that they've translated into a return on capital. So let's keep going here. I'm just guessing, from everything you've told me, right? And this is the fun thing about when you've done this enough, you can probably just guess what their return on equity will be, just based on the business itself. As just as an exercise. Okay. I think we've kind of talked about this already, but let's get your official answer here. How durable is the competitive advantage, and what do you think the risks are to their competitive advantage?
Yeah. So, short answer, I think they have a pretty durable competitive advantage. Like you said, I think the intangible assets, you talked about the 100 years of history, I think that certainly contribute to this durability. When we talk about competitive advantage durability, I think that certainly is part of the equation. Some of the risks that I want to bring up in the in the face of coronavirus, in the face of people talking about resilient value chain, resilient supply chain, there's something important to bring out, which is that they have a lot of manufacturing entities that they have signed joint venture deals with in China, especially in Wuhan, which is interesting. So I'll give you some names here. Beijing Photon, and forgive me if I can't pronounce this correctly. Beijing Photon Cummins Engine, Dongfeng Cummins Engine, et cetera, et cetera. There are a few that is pretty big. So, I mean, I would say that's one of the risks. Another is, one of the big risks with these manufacturers is that, yes, they have 100 years of history, but there's always this risk that companies downstream might just say, hell with this, I'm going to make my own diesel engine. There's always, that risk. I just wanted to point that out. It's, the probability of that risk actually materializing is probably low because of, as we mentioned, it takes huge amount of capital just to get the production line ready, and the entrenched tribal knowledge that is part of the company. It's hard to replicate that just like that. So I'd say it's a risk, but it's a fairly limited risk. And then I would say one more thing, which is that diesel engine is is powerful. It's very useful for certain things, but it does have a lot of environmental damage. And with legislation being brought forth to limit those environmental harm, it might cause some damage in the future. So I would say those are kind of the risks I want to highlight. But overall, competitive advantage, durability wise, I think they're pretty, pretty well equipped.
Yeah, I mean, I think the environmental factor is probably the biggest risk, the biggest unknown risk, right? In that, I think it's pretty unlikely that another manufacturer would start building their own engines, but you may see them replaced by either electric vehicles that uh, somebody else manufactures and Cummins doesn't have the best, or you see the legislation kind of eliminate their most efficient, their engines from being used. So, okay,
Yeah.
let's keep going here. What are the company's long-term prospects and runway for growth?
Yeah, so I think this one really, as I think this one's kind of hard for me to answer for a lot of these companies that are more upstream of the value chain. Like, say, for example, like this company, I think is a good example here. Like the future prospect for this company depends really on the growth of diesel trucks, diesel engine trucks and then generators. At least because of the revenue mix of this company is heavily relied on these two segments, right? Diesel engine, the power generators, and also the service component of it. It does require on the industry downstream from them. And I just did a quick search on it, and um, with many caveats with these kind of top down research, you can buy them for like thousands of dollars. You can get just high numbers on them, but the compounded annual growth for global diesel engine market is expected to grow at about 4.5% every year until 2025. That's what they say. It's hard. It's really hard for me to verify this, but I think it's about right. It's not going to grow exponentially. It's not going to grow at 10%. I think it's going to grow at around that rate, just a little bit above GDP growth. Um, so I think that just roughly makes sense. If you translate that number to what this means for the company, I think long-term prospects, it's still relatively decent in terms of the growth rate. It's not a dying industry, but it's not like the darlings of Wall Street right now of tech industry where they're growing at, I don't know, double digits. So
Um,
in terms of long-term prospects and runway for growth, there's still certainly room for growth.
yeah, but sometimes the best growth is in the businesses that nobody's paying attention to because you can buy it for cheap. So
Yeah.
obviously we'll have to look at that when we get to the valuation. But let's keep moving on because we're running along on this the first episode. Does a company require a lot of capital reinvestment to maintain its business, and can it grow without further reinvestment? And I think we've already kind of answered that with the capital intensive discussion. But what are your thoughts?
Yeah, I think I think this question is in line with what we talked about earlier, in that it is a capital intensive business. You're gonna have a lot of R&D expense. There's gonna be depreciation, amortization. There's always gonna be capex spending for property, plant, equipment, and other things to make it more efficient. Um, if I can just give you a quick number on the capital expenditure, um, its capital expenditure in 2019 was around 750 million, and it was around 750 million last year as well, 2018. And it's always been around that area. It's always been around that. And if you want to put that into perspective in terms of that divided by net cash flow from operation, it's about 25 to 30%. I think it's more on the 30%. Um, so you're talking about a significant amount of capital reinvested into the business.
Okay. Um, let's talk about the relationships that the company has with various parties. And I'm gonna just give you the list, and then you tell me if any of these throw up any red flags. So, customers, suppliers, employees, or the regulatory aspect.
Yeah. So I'm just going to point out a couple of things here. One is regulatory, and then the other is supplier. So I'll answer that in reverse. So supplier, uh, 19% of all of their materials are from a single source supplier. And I really want to bring this out because I think this supply chain issue has been in the limelight because of the coronavirus and with the optimization for efficiency, we have kind of forgotten about thinking about resilience. And I think this question is relevant to us right now in that, how do we think about supply chain when you have 19% of direct materials coming from a single source supplier? And so just wanted to point that out as something to note. In terms of regulatory, this is another thing I think you correctly pointed out, Hari, that this could be the big unknown for the future of this company. And you can see in 10K that there has been some tussle with the regulatory in terms of the emission standards and things like that. So something to keep an eye on. I don't think there's nothing in the near horizon where it's going to be a killer for this company, but you never know with regulators, right? I mean, look at Boeing, for example, or look at. I mean, it does. You need to pay a lot of attention to this, but
Yeah, I mean,
as far as I can tell, not no huge red flag.
yeah, I mean one area that could be is that they outright ban of things is usually not how regulators do things. It's typically what they'll do is they'll incrementally increase the cost and effectively damage the margin for the business, right? And I think that's the bigger risk here is that this company has a healthy margin, and it slowly gets eroded because they have to put more and more expensive things into their manufacturing process, and eventually, they can't pass those expenses on to the customer, and so it ends up costing more and more money. So, that is where I see a bigger risk on the regulatory side than an outright. There won't be any more diesel engines. It'll just become too expensive, or the alternative will become cheaper, relatively because of inflated cost for the diesel side.
Yeah.
Okay.
That's a great point.
Well, I think we're gonna run. This we're getting to the end of our the first part of our discussion about Cummins. Did you have any more comments about what we've talked about so far?
No, not really. I think we'll talk more about the business, the financials and management side of it on the second episode. I hope you guys enjoyed it, and hope you guys enjoyed the quality of the audio. Hopefully, it's better. So
Yeah,
that's it for me.
and I just want to mention also that we hadn't talked about this before, but we have a Slack community where you can interact with Becco and myself directly. Message us, talk to us about various questions that you have, and also bring up investment ideas, give us feedback on the podcast. So if you're interested in getting onto our Slack community, send us an email, info@valueinvestor.org. And as Becco mentioned, you can also send us an email to get the checklist, give us podcast ideas, what companies to talk about, and so on. So we'd really like to hear from you if you can, info@valueinvestor.org.
Great. We'll talk to you guys in the next episode.
All right.
Thank you.
Thanks.